morning, everybody. Welcome to the party.
Good morning.
There he is.
How are you?
Not bad at all.
Good.
Uh,
Good.
Just like we were just talking before coming on here, just nothing to do.
Yeah.
Nothing to do. Doesn't mean there might be something to do, but at the moment. I got to see something happen first. All right, we'll let everybody get in here and get settled, and then we'll get started. Scott, Tony, good to see you guys. Hope you're doing well. Happy Friday.
Yeah, I've been thinking about while we're waiting more people come in. That article about that guy up behind there in Fort Collins. That this thing freaks me out still because I've seen one of those in the wild. I had when the boys were young. I had one of them in my backpack. Right, you remember the little kid backpacks?
Uh-huh.
Man, my heart I thought it was going to pound out of my chest when I saw that thing. It scared the dickens. Crazy. Those things will shred you, man. They're quicker, faster, claws, you name it. They're going to shred you.
So what JP and I are talking about is this week. So I live in northern Colorado, and they're just about a mile west of my house and office is it's City Park, which then abuts State Park, which then is connected to National Forest. So I mean, you can go a mile west, and then you're just in the wilderness. And this week, a guy was out on a trail running, and it's a trail that I've been on a number of times on the mountain bike. But this guy was running on this trail and was attacked by a young juvenile mountain lion. And the story is that the lion jumped on him from behind, kind of pounced on him. I think bit his arm and his face, and this guy killed the lion with his bare hands.
The guy's Iron Man. That's all I can say.
Like suffocates this lion, and then that's not the crazy. Then, because where this West Ridge Trail in Horsetooth Mountain Park, it's still 3 miles back to the car. So he gets himself all the way back to the trailhead and drives himself to the ER.
Crazy.
Which is just awesome. So it's been funny because guys in our training community know that I run and ride. And they're like, hey, was that you? And I was like, no, it's not me. But then I was thinking, like, my brother-in-law he actually lives up there, and he's the kind of guy that would do something like that. And and so I texted him. I was like, hey, nice job suffocating that lion. And he responds back, and he's like, it was no big deal. It was just a baby. And
yeah.
And so then I said, all right, I think the real impressive part was the fact that you did, stay with it. You got all the way back to the car, drove yourself back. He's like, nah, if it was me, I would have carried the lion out.
So my wife asked me, is there any cell service back there? Because, I mean, if you get caught, you're sort of toast,
On that, it depends on your provider.
Sure.
So if you can get on that trail, if you had Verizon, you could get access, but AT&T or anybody else doesn't have any.
For any of you who are on with us who are not familiar with the mountains and mountain lions, or what we call mountain kitties, I got to tell you, I have a healthy respect for those things because I've been tracked by them knowingly, and I've seen them, and I got to tell you, they could shred you in a minute, and they do attack from behind. They don't let you know they're there. And that guy is my hero because, man, I don't know what I would have done in a situation like that. Golly. Wow.
All right. That's
Happy Friday, everybody.
Happy Friday. So
on that note,
may you be able to suffocate a mountain lion with your bare hands.
Or have the speed to get away.
Or have the speed, to get away. Well, let's jump into our session, shall we, and see what is afforded to us. And as always, we start with a little bit of a risk disclosure, just reminding ourselves that we are in markets, and Just like there's risk in every aspect of life, it's certainly something to be aware of in financial markets because just the risk cycle is more compressed. Yes, there's risk in lots of parts of life. It just happens faster in markets, and that we always need to be cognizant of that. I'm Josh. Here's just a little bit of my background, founder of Trade Profile, and with me on the phone is JP. We are your guides this morning as we are trying to get around a specific challenge, and that is really, how do you pick a better price target? When in our community, when we talk about looking for trades, we're always thinking about what's the opportunity, and we start with opportunity first. And it's brought around this idea: if you don't know where the target is or what the target is, how do you measure risk? You may see an opportunity to get in, and we often encounter traders who are able to get into the trade because they have a certain trigger or price pattern or something that they look at to get into the trade. But should you take that trigger? Should you take that trade? Why not? Why that one versus another one? What's the opportunity on the other side that is really attractive? And so, how do I pick better price targets? What's exceptional behavior that I can lean on toward those targets is really the challenge. And hang on a second, I need to put an order in here real quick. Been waiting for this all day. I don't want to miss it. Actually, oh yeah, here we go. Awesome. We'll cover that one in just a second. This is going to be something that we'll be talking about next week with respect to where our community will be going. We're going to be talking about volume and range and what to monitor in the auction. It's kind of part of what we look at every week, which is we're always trying to angle around everything that we talk about each week is trying to help us in these three areas of what are behaviors that we can observe in every auction. We believe that there are 4 behaviors observable in every auction. What are questions that you ask before entering a trade? Well, one of the questions that you ask is, what's the target? What's the opportunity? Why am I interested in this trade? And there are 4 stages of auction competency. What are these stages of competency? It's when is there a better opportunity for me than another? And the risk, if you don't have good targets or can understand exceptional behavior, then what's going to happen is you're going to trigger into trades without defined risk to reward, as well as you're going to enter with low confidence that the trade will stick. And we were on a call this morning with a trader in our community who just talking about, this is a very competent guy who in any place that he looks to put effort in his life and work, it translates into success. And in markets, there's a great challenge. It's part of what intrigues him. But this confidence thing is always a hard thing, because even when you have a good approach and a good system, there's no 100% accurate trade approach. Doesn't exist. So we're always going to have the hold the ego lightly. Doesn't mean that we can't have better approaches than others. It just means that we know that, hey, I'm going to take that trade and I was going to be wrong, and that's okay. But am I defined around that? Here's the principle that we're going to lean on. One is that the observed volume, either during a period or the volume at price and the range of the session. One second, I should have been. Okay, it did fill. Okay, great. Is an indicator of which auction participant is in control, and it's a participant to lean on and align with. So one of the things we're always trying to do is we're trying to find participants that we can lean with. We don't want ever to be the first guy out there. So if we want to work on increasing our performance, we want to align ourselves where we have a better shot. So even, no shots 100%, but there are better shots. there are better opportunities than others. If you're running on a trail and there are lions out there, if you don't want to get attacked by lions, maybe pick trails that there aren't lions on. There's better decision making around it. Or know that if attacked by a lion, as we talked about earlier, you could suffocate it with your bare hands. Still, just
Not the best option, though.
not the best option. Not the best option. So as you grasp this, here's the ultimate outcome: is that you're monitoring volume, including volume at price and range, knowing what's exceptional behavior and how to include these metrics into your plan. So real quickly, let's jump over here to the charts, and I want to talk about crude because this is we're finally, hang on a second, into an area that I was looking for all day long.
Finally got the break.
Finally got the break. And all day long, we were talking about 52.23 all morning long. And the question is why? Why are we looking at 52.23? So a couple different reasons. So yesterday's auction, the most traded price where we spent the most volume was this 52.23. Also, if I go out here and look at a longer term chart, you're going to see that the most traded price for the last month is 52.23. If I go and look at the last 9 months, or I'm sorry, last 3 months, 52.23. So what, JP, is the most significant price that we're close to in this auction?
We're at it right now.
Yeah, 52.23. like that's the price. So this morning we have a couple different key setups that we look for that are based around what's happening in the first hour of trade. But if you were looking for an opportunity today, one of the we're always looking at decision level. So part of a plan every morning is looking for a specific areas that we're looking to do business, and these are areas that we either look to target or they're areas that we look to do business once reached. And one of those in our plan today was this 52.23. So there was opportunity to target this, and you notice that we hit this price and immediately stopped. That's not a coincidence. It's not a coincidence. So that can become a great target. It can also be an opportunity to say, okay, and this I think is the trade that may be left in the day, is now that we've spent several hours balancing and trading back and forth across 52.70, that's a target for later in the session. So I'm going to look for intraday long trades. As long as we hold 52.20, I'm looking for trades back up towards 52.70. So that's about 50 cents, right? So that's 50 cents is the opportunity. So then the question is, what am I willing to risk to get that 50 cents? So I've got a clear target. Now I could overlay on top of that, specific price pattern triggers or other things that could help me. The other thing that I'm going to look for, and this is stuff that we'll be talking about next week, is period volume. So notice in this last, not the 5 minute that we're in, but the one prior to that, look at the intensity of the selling volume as we went into this level. Okay, it was the highest of the whole session. So if I want to be long, I'm cognizant of the fact that sellers they have the upper hand on this. So I'm going to look for some kind of trigger. I actually would like to see them try to push below this price here and fail and get back up and see some significant buying volume come in that I could lean against toward this price.
Go back to that other chart, Josh, we were just looking when you asked that question of me.
Yeah.
Okay, so we know in this instance that 52.30, 52.33 is the area right now, or 52.23, whatever. It's an area. It's not an exact number. Why wouldn't we go down and say, let's just hypothetically say, why wouldn't we say 50.50? Why is that not an area down there to target? Can anybody answer that question?
So we're looking at this area right
here.
Yeah.
Why wouldn't you use something like that? Anybody? Bueller. All right, so we got one. Who said that? Low volume node. Yeah, Joel, that's one reason. Yeah, but there's really nothing of significance down there. Okay, so we know, like, let's say price just absolutely ripped through this area right here that we're in right now, took out the lows of that last candle. This is a daily candle down below. If it takes out that, what do you, and when you're thinking of targets, that's why we always use like high volume nodes for targets and stuff like that. So if it does rip through there, what kind of chance does it have to keep going? It has a darn good chance of sliding for a while. Okay, so that's, however, what Josh is trying to say is that, listen, we know, and I said we don't know, we have a good idea of areas where it could stop. So we can calculate those targets to those areas like we did with this 5223 area. However, we can't calculate down below at 50-50. We just can't, because, all right, who's going to step in at 50-50 logically? Nobody, because there's nothing down there. It's a thin spot, as we call in the profile. They'll rip right through that, most likely. Now, the next line in the sand, where would the next line in the sand be? If they, let's say they bust through this 5223, where's the next line in the sand? Well, logically, it'd be like the 4950 area. Yeah, 4960. Good job, Joel. You're cheating, Joel. You're in with us already.
Well, and I've also got it here on the screen. I mean,
true. Yeah.
You know.
But yeah, what I'm saying is that how come you wouldn't calculate it to 4950? Mm-hmm. It's a logical target, right? No. Yeah, it is, but you have better targets above or right below you, right there at 5230 or 5223. Why is that? Because we have higher volume. We've done a lot more business there than we have at 4950. If we slide through there, then your next target you would if you're going to hold that long, of course, it depends on your time frame, then you would look at that 4950 area then, or 4960 area. And again, I'm talking areas. I'm not talking exact numbers, because there's no such thing as an exact number. Right. So anyway, just an idea that why you wouldn't do one over the other. Wouldn't that 50-50 LVN also be level that no one is interested in and is cheap value? Yeah, Jack, you're probably right. It doesn't have a lot of business down there.
Yeah.
Okay. But on an intraday, see, it wasn't intraday days. How many days is that? Is that only 2 days of business there, Josh? Is that right?
Where's that?
On your on the 7th right there, January 7th on that high volume. Was that only 2 days of business for your chart?
Yeah.
You're right, Jack. That probably wouldn't stop the market, but it's a heck of a target. So you could take some off around there.
Yeah.
I wouldn't use that personally as an entry, and that's not what we're talking about. We're talking about targets. But targets. Yeah, that's a good point. And let me see, somebody else had
well, and Joel mentioned this is the thing that we talk about. So why look at an auction this way? And this is just on this chart. What I'm looking at is I'm looking at a composite of where the volume at price has been for the last month. This is the last 3 months. This is an individual month. This is the last week, right? So I'm looking for confluence of these prices, depending on where I'm looking to do business. But let's think if your time frame is on a daily basis. Okay, so say you're a swing trader and you're using daily charts to trigger in. And let's say, what triggered you in is if we close today and then, on the next session on Monday, we get a lower low below here. All right. And that gets you below this big level. The auction moves from, it basically auctions back and forth between these levels. So, the question would be, okay, if I got in, if that was a trigger that got me in, on new lows, well, what's my target? What am I looking for? And, that makes this the most reasonable next target, because that's the next area of inventory that we could, go for. And then, where could I have risk? Well, as long as I can stay below this area of inventory, then I've got a good shot at that. If I turn around and get back above that, well, then this becomes, in a sense, support. Because what are you looking at when you see a build out of volume here? You're seeing two-sided trade. You're seeing buyers and sellers active together. So if I'm below that, then I can lean with those sellers. If I'm above that, then I can lean on those buyers. So that would be a really nice target. And the other reason why we use the high volume instead of the low volume is, could we target into this area? We absolutely should. We could. Typically in a low volume area, because it was a rejection, there wasn't much activity there. The auction can come into those areas and like very quickly reject out. When we come to a longer term area, it gives you an opportunity of time. Like you don't have to be like watching it, right away. You can make a decision around that and expect that the auction is going to slow because there were buyers and sellers there before. Very likely that there will be buyers and sellers there again.
Yeah, and Scott has a great question. He says on the 50-50 area, in that low volume area, as a target, why is sliding through a bad thing if you're short? No, there's nothing bad about it. You get your target. However, when calculating, that's the key. What's the only thing you can control in trading? It's your risk, and we use targets to be able to define our risk. So, can we go back to that chart real quick, Josh?
Yep.
I'm sorry. And let's just take the other side of this trade. Blow that one up if you would.
Hang on a second. I'm just kind of watching crude here to see if I get that long trigger.
Okay. And I'll finish that thought here in a second.
Okay. Not yet.
Okay.
Okay, go ahead.
So if we go back to that middle chart there and blow it up.
Mm-hmm.
All right. So let's, Josh, draw a line at just above 55.30 there at the top of that candle. What is that? About 55.66. Just draw a pencil line up there.
Or this one?
No, up higher. 55.
Oh, 55.
55.66. Yeah. So, okay. Hypothetically, let's say that's your trigger long. If you trigger long there, logically, before you trigger, you're looking for what? You're looking for your targets. Where would a logical target be for something like this? Well, Josh already has it marked. If you go back to the left of the chart, you're going to see you have a couple high volume nodes here. Yeah, exactly. So 57.27. So we look at that and say, okay, 55.66 to 57.27. Yeah, okay, you got about 80 points in there. Or excuse me, 60 points and some change. It's not huge trade. So now, how do you set your stops on there? What's your risk on this trade? Okay, well, if you have a plan, you probably have a trigger, which would mean you're probably entering off of a shorter time frame. Maybe a 10-minute, 15-minute, 5-minute. I wouldn't advocate anything less than a 5-minute. Then you can define your risk. Is that risk, in other words, is that target right there that we're pointing at, that 57.27 area, is that a multiple of what your actual stop is going to be? And what we mean is, is your stop 1 unit and then this would be 5 units? In other words, it's 5 times larger than your stop, or is it a 1-to-1 where your stop has to be the same as the actual target at this point? Now, does it mean it's going to go right up to that right away? No, it's going to gyrate. It's going to go up and down, maybe even go sideways, maybe even come roll over and take you out of your trade. Okay. But what it does is allow you to say, okay, that's a logical area. Why is that? Because trade and business has been done there before based on the volume as Josh drew up there. And that's a logical target. Okay. That's why we always look at targets along with the entries matter, no doubt about it. The risk matters more. Okay. In other words, can I get the right risk down? Okay. Now, again, doesn't guarantee that we're going up there. That is even though that has some high volume to it, it's not quite what we're looking at right now in crude at our current level of 52.23. So does that make sense?
It might.
I think it does.
I think it does.
Nobody's balking at it.
Not yet. Okay. I'm nibbling along on this crude here.
Thanks, Tony.
We're seeing some buyers stepping in above this level. So my risk is 52.35. I'm looking for 70.
There they go.
Yeah, they're
swinging it now.
Yeah.
We're getting some bounce on those NASDAQ trades too. So.
Yeah. Yeah, in terms of a target here, in the NASDAQ, there's a price that we've been talking about all day, which has been this 87. So, I mean, there's the other side of this coin. Okay, so one side of this coin is having a target. The other one is activity that you can lean on to have, so first you've identified the opportunity. So we always start with what's the opportunity. Then we say, okay, what can I lean on to get there? Right here, so you can see that the auction tried to go lower on pretty decent selling volume and immediately turned back around through a volume area or inventory level. So you got sellers that got trapped and now they're back above this with buyers that were just about as strong. So that's showing me that I got buyers canceling out those sellers. And so these sellers, if they're still there, they're likely, starting to freak out a little bit. This is something I can lean on if, say, I wanted to be long for that 87 target. So, then the decision is, all right, does that make sense from a risk reward standpoint? And where would I be wrong? Well, if I got back below this volume area and even challenged this 5-minute low, I'm likely going to be wrong because that might re-embolden these sellers that were on their heels for a second. But if, the defined target being up here, you can see that the reward is greater than the risk. I like that trade.
Yeah, so it's almost 10 points of risk to almost
about 20.
So it's a 2-to-1 ratio. It's not perfect, but it that works. You can make money with that if you even take a dinger. So
yep.
I mean, we'd love to see more, 3 or 4-to-1. Those are the sweetheart trades, but this works. I have a feeling that we're going to go up and test those highs up there. So
yeah. So that's, and why we always talk about in terms of reward to risk, and we try to do that, the reward in a multiple of the risk. Again, because even though there's good probability setups, so there's setups and trades in our playbook that have good expectancy, none of them are 100%. So you're going to be wrong. Well, if I'm only ever entering trades that have a 3-to-1 reward to risk ratio, then I could be wrong twice and still break even. Actually, you still end up even doing a little bit better because your stop is such a difference to where your reward is. The other part of this is, and I've heard other traders who always will define a risk reward. What I find is interesting is because they don't use the profile, they'll pick a number as the reward that they're looking for, but they have no idea whether that's realistic to hit that number or not. Like, what do I mean by that? Like, say I wanted to get in right now at 68.70, and I said, okay, well, I'm going to risk, I'm going to risk 10 points because I'm going to make 100 points. Like that, like I want to do a 10-to-1 risk reward ratio. All right. Very low chance, very low probability we're going to get 100 points today. Very low probability. Why? Because we have a whole mess of inventory. You can see over on that composite on the right, there's a whole mess of inventory to cut through that's going to slow this trade down and likely stall it. And especially if we get back up to this 87, that's not just yesterday's point of control, but that's also a multi-period point of control. So there's going to be plenty of sellers up there to pause that auction. So if I came in and tried to construct the trade of, oh yeah, I'm going to get 100 points and that's my risk reward, you just kind of pulled that out of your hat. There wasn't any any rationale around it.
Yeah. Something else I want to point out too is that just because you target that and make the risk reward. Now, again, we do that specifically because there's been business done there. Okay. There's been balance, acceptance, volume, however you want to define it, it's been there. And if you understand how markets work, now there's an argument out there, and there'll be some individuals, some very popular individuals that, markets are random. Nobody can tell you what they're going to do. I would agree with that to a certain degree. In other words, they are random. We don't know what they're going to do. However, what we do know is we can control our risk. Mm-hmm. Okay. And we do know that auctions, the auction or the market process does one thing. The actual process goes, it balances, it accepts, it rests. In other words, there's equilibrium in pricing. And then what it does is it auctions away from that and it tests. It's just like a regular auction, guys. Just think about when you go to an auction or see one and you're bidding up right? And that's the auction process. They're testing. Let's say the auctioneer tests up and he's trying to get you to somebody to take it at $10. Nobody takes it at $10, so he drops it to $9.50. Nobody takes it at $9.50. They drop it to $9. Okay, that's just what if it's a real hot item and somebody bids $10 and they jump at the 12 and then 15 and stuff? That's the auction process. Okay, so it's the same thing with the markets. And when markets, what they call them, you could call them a breakout, you could call them a move from the middle, you could call them a move from balance, they auction away from an area. There's lots of different ways of describing it, but what happens is when it does go, it's looking for either a responsive a response. In other words, are there sellers and buyers that are going to push it back to that area, or are they going to go down to a place where business has been done before? If you look at you look at anything, Josh, do you have a profile chart that you can go back like on a daily basis and just look, like the E? Or actually, do you have the 6E up by chance?
I can. What kind of time frame you want?
Put a daily basis, just a daily profile. And just open the profile up. Yeah. Okay.
Is that what you're looking for? Do you have
yeah,
it? Do you want to
just put it? No, just put it up on the daily, that center chart there. Yeah. Just maximize it. There you go. All right, and then squeeze it in for me, so we can see like 16 and 15 if you can go back that far. 2016 and 15. All right, perfect. Okay. So what you can see here is back in 2014, we broke from the high. We came down, we broke a little small area of balance up there at 139 as a high, and it auctioned away, and nobody was willing. They have found no responsive buyers in there. Okay, and that thing just absolutely tanked. But then it finally found some buyers and some equilibrium. Some buyers and sellers were in balance with one another, and this thing actually went sideways, or it accepted price for almost 2 years. Okay, that's a long time. Then what did it do? It decided it wanted to auction away. But inside that little balance area, we had a lot of mini auctions, especially that last one. Actually, we caught this one. Whoops.
I'm going to go to a different chart here real quick because you're going to want to see this. This is going to make more sense.
Okay. And I see you. Hang on, there's a chat here. Tony, I'm going to get to your question here in a minute. It's a good question. There you go. All right. So yeah. So what you'll see here is we break down that area there. That was that waterfall. Okay. And then what happens is we go ahead and we are balancing for a better part of 2 years. Okay. With inside that area there is different areas of balance that they break away from and go test. Now you can see the big area that Josh just drew right there. And once you see that right before we broke out above that on around 5/18 of 2017, okay, there was a little mini balance area right below that where you just made, there you go, right there. Nope, down below a little bit more, right there, perfect. Yeah, so right there, we auctioned up, and I was watching this, and we actually caught this from the bottom. We saw the bottom, we didn't catch the bottom, we never catch bottoms. And then we started to balance, and we started hitting those volume nodes up above. Once we got to where Josh drew that last line right there, that was the one that we said, okay, if we auction away from that, we know we have some chance of going up and testing some areas that are really attractive to us. And here we are. We actually were targeting the 127, or 125, which it actually hit. We actually caught a lot of that as well. But if you look at this and just look at the patterns and the way the auction works, it auctions away from balance, and it's looking for responsive sellers or buyers. If not, it's looking for balance at that point in time. That's what auctions do. So when somebody says, oh, it's a random walk in the marketplace, yeah, I sort of agree with that, because we don't know if it's going to go up or down, right? But what we can do is if we have some targets and we sort of have a bias, and I think, Josh, we've talked about that in the past calls, if we have that bias, then
what we can do is determine if this what we use, what we call an if-then state. If this market breaks out or goes and starts to auction away from this point, then at that point we want to define our stop, and we want to define our targets based on X, Y, and Z. So, you know, just understand that we don't make this stuff up. This is stuff that if you go back and look at your charts and your volume charts and your TPOs and stuff like that, you'll see that, you know, when markets move, they auction to, they're looking for where past business has been, or they're looking for, you know, or they're going to go there and stop and balance, or they're going to move away from that because there's responsive selling or responsive buying coming into that. Hang on, we had a question, Josh.
Yeah, we had about stops.
Yeah, how do you assess potential stops? You want to cover that on like triggers?
Yeah. So let me get over here real quick. Find a good example. Okay, so we were all talking about that that 5220 down here in crude that we hit, and you know, now we're moving back up towards that 5270 area. So setting stop. I mean, how many have you always set stops? You know, people talk about trading with stops. When I find people who don't like stops, it's because they're like, well, I put a stop on and then the stop got run and then I see it go in the direction that I thought it was going to go anyway. When I ask about the stops being set, what I often find is that there's some random number pulled out. Like someone will say, well, I use a 5-point stop, or I use a 2-tick stop, or I use a 10-cent stop. Right? Why? What makes that number significant is the question that you have to ask. Numbers are not as powerful in markets as behavior is around a number. So let me say that again. Numbers are not as powerful as behavior around a number. So having this 5220 being an area that was either a target for a short, which it was, there was a short here. I want to look at this two different ways. I'm going to show you two different stops. Okay. Let's talk about the first one, because we knew that 5220 area was a target. So that means I'm looking for an intraday entry. I want to find an area of high volume sellers. So what you're looking at right now is these are equivolume bars. So rather than seeing volume in a subgraph down here, it actually merges it with the 5-minute candle. The benefit of this is it helps you see visually which period was more significant than another. Okay, so and the rationale is if I have strong buying volume, then that should lead to follow through and lower prices. If I have strong selling volume, or if I have strong selling volume, should lead to lower prices. Strong buying volume should lead to higher prices. And until that's taken out, that's in control. Well, the first trigger that happened today, and we knew 5220 coming in this morning. So the early one was right here. See this strong. Look at it relative to all of the prior 5-minute periods. It's pretty clear how much stronger this one is. So where would you put your stop? Again, if the target was 5220, the stop is 1 tick above that period. And why 1 tick? Because I'm leaning on those other strong sellers and I'm going with them. And if they're out, I'm out. So I'm not using a 5-cent tick or 5-cent stop or 20-cent stop. I'm using a behavioral stop. Okay, and you can see that throughout the rest of this session, there was a little bit of a squeeze right here that would have come back toward it in this period right here. But otherwise, it is this has held. There was another one that happened later in the day. It was actually right here. And you could have a stop right above that one as well and see how that actually held. And it got threatened. Sure, it got threatened, didn't it? But the power of these strong sellers held it. So you're using behavioral stops, not specific numbers. So
can I jump in here quick? Because I know there's going to be a question, because we always get it. Well, aren't the algorithms going to, target your stops? Yeah, they could.
Yeah.
Guess what? If you get stopped out, you're wrong. Okay. But you're controlled. The whole point is you're controlled. You will get stopped out. And I just we got to sort of be real about this a little bit, is that you will incur small stops, and that's part of trading. That's, actually successful trading is that's part of the game plan. Okay. But again, they're controlled, and they are, they're defined, just like what Josh just showed you. If an algorithm then, program gets turned on, they come up and take your stops out, then so be it, that you're out. And then they could do the fill and kill, what they call it. They fill it and then they roll it over and kill you. Right. That's what Josh had talked about before. I get stopped out, but then they turn around and they go in my direction. Yeah. You know what? That happens too. And it happens to all of us. Okay. But it's a good point, Josh. It's a behavioral type of situation. Now, the opposite side of that would be, okay, we've gone down, now we're going back up. What if they take out that high up there that Josh had his stop at like 52.99? What would that tell you then? Mm-hmm. Okay, they could run stops up there. If there's stops up there, that's the stop run at that point. And then, what, we had a quick question here.
Yeah, the other one was, okay, I'm going to jump ahead. Jack, we're going to get to you in just a second.
Yeah.
Tony was asking, so what's the stop for the 52.23 long? So the initial stop was right here. So on this 5 minute that broke higher on good volume, the stop is here. The stop is now at the bottom of this 5 minute of buying volume.
And I'm going to say, with an asterisk, that depends on what your time frame is.
Totally.
Because on Josh's, which we use on an intraday basis, is a 5 minute trigger chart. Okay, that's pretty normal for us. However, if I'm swing trading, I probably using a 30 minute.
That's right.
Totally different stops on that deal, and this probably wouldn't be a 30 minute trigger for me.
No. Yeah, and you can do this. You can do the same thing. I mean, if you were, you can see even on a longer time frame, and actually, notice all of this big selling that came in yesterday. Where did it really accelerate? Okay, this was buying post EIA. So if this is good buyers to go with, and the plan coming in to yesterday was actually that we were going to move higher. That was the plan coming in yesterday. And that the bias was, well, if we start to challenge these buyers right here, this thing could flip, and in fact it did. So that actually helped to not try to stay with the long narrative, but actually free your brain up to be able to be short, which was awesome.
Josh brings up a good point. That selling started below that large volume candle right there. So that is what we would call the pain trade. All right, what's the pain trade? Well, you just see it right there. That's when everybody who is long has stops right there, or does not have stops, and we get this accelerated move because people, what we call pikers, short-termers, they are late to the party, and they think they're going to get a home run up here, and they get shaken out of their trades, so they're jumping out of their trades. So it exacerbates the move. It makes it go quicker, and also with large volume, because everybody's screaming in pain because they're getting stopped out for a loss on the deal. Mm-hmm. So sometimes if you look at it, sometimes, on a weekend, I'll look at the charts and I'll take a look at them and say, okay, where's the pain trade? Where if price moves to that point, people are probably going to be in pain. In other words, where are the stops at? Where are they going to take a lot of stops at?
So Jack, I'll jump to your question. So you were asking about, what's the study called that paints the candle based on sellers versus buyers? So that looks like this. Turn this off. So this is looking at bid ask. This is order flow. So each of these 30-minute, this is a 30-minute histogram. So this is a 30-minute period. Oh, different color. This is a 30-minute period right here that's showing me where was the intensity of volume at price. Um, and a really, micro description of that is, okay, in terms of positioning, it's an auction. So, if I'm above this, if I'm above this, this area of volume, I might be buying above volume. If I'm selling down here, I'm selling below value. So that's helpful there. Overlaid on top of that is a 5-minute period, and this is a histogram showing me the intensity of trades placed on the bid or the ask, or the delta at price. And that can be helpful because that can help you look inside of a 5-minute period and go, not only did it have strong period volume, but when I look and say, well, what type of activity was that? It was, like in this one, this was strong selling, because all of the delta and the intensity was on the sell side, which is leading to lower prices.
He's also may have asked about Thinkorswim on those volume candles too.
Yeah, on if you guys have tossed, this is just called an equivolume bar. How you get to this is you just go into style, chart mode, and click on equivolume. That's what that's called.
If you want to flip over to the beans, WASDE was out, and they've got some wild moves going on.
Yeah, so let's.
Yeah, you're welcome, Jack. Good question.
This is a good product to look at right now.
So in beans, while Josh is pulling this up, they had their what is called the WASDE reports, the World Agriculture Supply and Demand estimates for the agriculture industry. We missed January's report because of the government being closed, so we never got year-end numbers from 2017, or excuse me, 2018. I'm a year behind. And that was released today, both January's report and also, or excuse me, the December's report and also the January's report. So that's why there's a lot of movement here.
It's actually not that much movement.
No, corn swung out quite a bit. So I haven't read the report yet, so I'll have to look at it this weekend. Somebody's going to say, okay, why are you looking at a report? Are you a fundamentalist? No, I'm not. I have a background in the agriculture industry, so I read silly stuff like that. So
yeah, we only look at the report as to know, hey, there's a binary event coming in. By binary meaning it could go higher or lower. We don't know. And so what we look for on an event like that is we look for, how does the auction behave? Coming into the day, there was a reference that I was really interested in, is 921. That's been the most traded price in beans for a while. I also have a big level down here at 895. And so after the report, I'm kind of interested, which one are we dealing with? Are we dealing with this one? Are we dealing with this one? I don't know. We'll find out.
I read it because I'm weird and like reading stuff like it's just something that's been ingrained in me so long. And then also so I can be prepared when my friends in the agriculture industry call me and ask me what they should do, which my answer is always the same. I don't know. Cards tell you. Joel says ACT 910, estimate 920. Joel, clarify that for me, would you?
Oh, go get that. Go get that. Come on, go get it. Go get it. Go get 921. Do it. Do it. I can neither confirm nor deny whether I'm wrong.
That's funny. Like rally there. I will tell you I am neither. You may have any questions? I mean, hopefully it was clear a little bit on those targets and stuff. First you have to define your time frame, what you're trading in, and then, because micro, macro targets and stuff like that. But you have really the profile provides, in my opinion, the best targets out there, because they're off of things that are not lagging. They're off of price and volume. So.
Come on, squeeze them. This is something we call a second move here, where after release, they take out the opening range low and then they come back through. That often leads to some acceleration, and the target would be, to see if they could get to this 921.
Yeah. Like
And
to
as
see 'em
long as
get back
as long as
above
they
it.
can hold above 911, I'm good. I'm good to be long this trade. And target first target would be 921, and then 926 up here.
Yeah, we can get if we can get it back above 921 and hold,
Man.
then
Yep.
I'm looking for my swing long on that 929 break up above again. They stung us last time, but
Yeah, because let's just look at.
we got a lot of thin spots up above there.
Oh, so it must be somebody coming into the office here.
Yeah, mine's sacked out right now on the couch in my office.
So if you look at this 970 is an area that to the upside is really interesting.
Mm-hmm.
If we can, to your point, if we can get above.
Yeah, we poked up above 929. They got their head cut off, but like I said, on the way up, for guys I'm looking at on the way up, I've got a target at 956 on the beans on the upside, and then
Hey, hang on a second, I'll be right back, guys.
Yep, 970 is a great target, and then above 970, I have $10. So that's where we've done business in the past. That's why I've been waiting for this swing. Soybeans, along with corn, has been going sideways for a long time because there's been ample supply in the marketplace. Even though we use profile, there's no doubt about it. That's the way we take trades. But we're also just very aware that this is still a supply and demand market, just simply that way. Just like crude oil, the grains are supply and demand markets. All right, so got to be conscious of that. However, we're not going to trade it. Yeah, that's why we watch those reports. Josh is only 4 points away from that. Anybody have any questions? Anything? Markets, profile? We always ask why the moon is round, but we've answered that one before. So anything, guys? Feel free to ask away. And by the way, there's no bad questions. I will tell you what. I almost said it earlier, but I'll say it now. We talk about stops. I want anybody to give me a Y or an N, obviously yes or no, for if you've been in a trade, didn't put a stop, and then it got out of control, and the only thing you could see was, oh snap, this is going to hurt when I stop out. So just put a Y. And again, guess what? I've done it. Josh has done it. It's happened. Okay. Joel, not that many, bud. You haven't done that many, Scott. Okay, yeah, it happens, guys. There's not one person in this room, including Josh and I, who've never done that before. That's why we want to make sure that you guys understand how risk is controlled. Okay, because in our young careers, many years ago, and I hate to even say many years ago, that happened, and it hurts. It's painful. Ever done it on a Friday afternoon? Oh. That's a painful one too. So just, yeah, guys, just, there's no bad questions. Don't be embarrassed. I mean, listen, Josh and I are experts. Well, we're not experts. What we're good at is making every mistake in the book, and we've done it. Yeah. And you know what? I'm sorry to say, God, I hate to say this because you know what? Everybody goes, well, you gotta make mistakes. Well, yeah, you do. Okay. It's not the price that you have to pay. Honestly, I hate that when somebody says, oh, it's the price you've got to pay to be a trader. No, you're just going to naturally do it because you're human. Okay. So just accept it. You're going to make mistakes, but you'll work through those mistakes. That's why, people like Josh and I are here to help you guys work through those mistakes so you can get to where you want to go, which I assume everybody wants to become a successful, profitable, consistently profitable trader moving forward. They want to fill their bank accounts. They want maybe some more freedom or whatever you're trying to accomplish. Well, to do that, we have to do a couple things, and hopefully we can guide you through that. So just understand, we've made every mistake. I promise you. There's not one. Somebody hasn't stymied us yet, right? I can't go, I haven't made that mistake. So any questions, guys? How many types of trade behaviors do you have observed? Is it do we observe or have we observed? Because there's loads of behaviors out there. I would say that I focus on, and let me just
let me make that word different behavior. I look at more of a trade methodology or setup, okay, which is based on behavior. You're correct, right? So whether it's a breakout, okay, which is a trade behavior, they're auctioning away, or whether it's a fade, which is another behavior where it's a rejection. There's two that we look at, and really, let's just be real. There's only 4 types of trades in the marketplace, and if you're an options trader, I apologize. I understand there's a gazillion option trader. I am one as well, so that doesn't count. But we're talking about in the marketplace here in the the commodities and future space. There's really only 4 trades, right? There's a I don't know if you heard that, but that's my my beast on the couch napping, and she was groaning there. It's Josh's twin dog there. So there's really 4 types of trades out there. There's a breakout, right? There's a fade, right? There's a sort of a consolidation range trade where you're just trading the range. And then there's a trend reversal, okay, which could coincide with, or what we call, well, actually a fade trade is actually a trend, sort of a trend reversal, but we're talking about a real trend reversal. So, or what would you call a counter trend trade, right? So those 4 behaviors are out there. So, that's really what we focus on. I don't know if there's even more than that. I guess there is, but those get in there. Those are really skittish then when you get past those 4.
Mm-hmm.
Especially when you're using, there's some mathematical stuff that swears by the behavior, which, if we get a 20% move off the bottom, minus the number of days in the lunar eclipse, then you should go short, right? That's not behavior. So,
Hey, I got stopped here, guys, on this little pullback right here.
It's on your how's your bean trade going?
They're holding.
All right, any other good questions? They're all good, by the way.
Yep.
Go ahead.
Your average. So he's asking max adverse excursion. So that's a metric that we look at when we go back and look at a trade to say how well are we doing at reading the auction. That's a great question, because when I look at that, Scott, I don't look at it relative to an average over time. I look at it to the specific trade relative to what the target was. So as a percentage of the target, I don't ever want to have, like, if you're defining your trades and your max adverse excursion is 3 times your target, then you're in trouble. That's a place where it's been more effective for me than looking at it like how big or wide that is, because the different setups are going to have different amount. Like if it's just going through our playbook, if it's a structure cleanup trade, it may be 2 points. If it's a IB extension fade, it may be 10 points, and that could be appropriate to that specific trade setup.
Yeah, I'd rather define that differently. I understand what you're saying, and that's actually fairly deep, and it can be used in a lot of different ways. I know a lot of the institutional traders use that, especially in the larger funds. Because
absolutely do it.
Yeah, I think. Yeah, how's the best way of describing that? Some people may not understand MEs.
Here, I'll pull up some examples here.
Yeah, do that. Honestly, in my opinion, I don't like back testing systems to look at that kind of stuff. So what I'd rather do is forward test it, and I'd rather use, options expectations, expected range and stuff like that. If you're going to use something like that, I think that's a better use. Do you agree with that, Josh?
Yeah, I like here's so for people who are part of our trading community, we try to put demonstration trades out that they can go on those trades with us, and we track those, we log those. And so here's just a track of trades that we've talked about thus far this year. And on all of these, we look at, all right, you know, how much was the trade for us? How much was the trade against us? And again, they're all different setups, right? So that you're not the nominal value of, the notional value of each trade in terms of an average is going to be hard to strike. What's a better way to look at that and say, okay, you know, how much adverse excursion is it? And even on the winning trades, like how much adverse excursion was there? I mean, like on this one, there was no adverse excursion. This one, there was very little adverse excursion. Like I'm always, if I can go back and look at my trade logs and go, oh yeah, there was hardly any adverse excursion on it, then I really like the trade. It's just a way to say, hey, was I reading the auction? If your mass adverse excursion, you know, is you're having a lot of adverse excursion, then you know your timing on your entry needs to, it's just telling you it needs to be tighter. That's all. It's a place to focus your development.
Yeah, and unfortunately, one trade that takes a lot of heat can really throw that off too. So and for those of you who may not understand mass adverse excursion, basically it's just the measurement of how much heat you're taking.
Mm-hmm.
Okay, and that's why I measured, you know, so okay, if we go and we look at options expectations, I'd rather look at that and determine if I'm in a trade and where we are as far as our range is concerned, then I could probably estimate how much heat I would take on this. But actually, personally, this is totally personal. I would never look at that because I'm going to look at like what Josh had pointed out. I'm looking at what behavior has done in that specific day, because every day is different.
Yeah.
So, but it's a great question. And really, we've never had that question,
no.
But we've experienced it.
It's very good to track.
Yeah. I think actually if you're an algorithmic trader, I run an algorithm, actually a couple of them, but that is good for that right there. I really do believe. Yeah. It's perfect actually.
Yeah, that's where it's going to be most important, is if you're running a systems kind of stuff.
Yeah.
Okay, we're going to wrap up. We have run out of our time. Thanks for all the questions. I mean, you guys really make the sessions. I mean, we just kind of come up with a general idea and then you take it from there and do more with it than we could do. So thanks for that. And I want to dive more into this idea of volume and range and setting targets specifically. That's going to be things that we'll be talking about next week. And so look for the link to join us for that. And we'll be back next week with another topic.
Awesome. Thanks, guys. Have a great weekend.